Hit record. All right.
Perfect.
We can let people in anytime. It sounds like we're ready.
Here they come.
Okay. Good afternoon, everyone. We are going to give 1 more minute for us to get started here. So stand by. But thanks for joining us. All right. 12:30. So let's get started. Well, I think some more people will start coming in as well. Just one minor housekeeping note is to just keep yourself muted primarily for the presentation, but there will be Q&A, so you'll have the option to unmute yourself then. So hello, my name's Angie. I am one of the people here that manage the New Ventures BC competition presented by Innovate BC. Thanks again for joining us. We are continuing our startup education series. So we've done quite a few seminars already, and we're happy to continue. We have a few more to go, and these next few are all going to be from some of our top partners and special topics, kind of things around financing, terminology, and understanding kind of more around ecosystem language of raising financing. So thanks again for joining. New Ventures BC, for those unaware, we're a nonprofit here in BC. We manage the annual New Ventures BC competition, and we also have a ongoing accelerator program with mentorship and an IP program launching soon called Accelerate IP. So stay tuned for that as well. I'm going to quickly thank my sponsors for this competition, and then I will pass it over to RBCx shortly. So first, in terms of New Ventures BC, we are definitely strong because of our wonderful sponsor and partner network. So our title sponsor is Innovate BC. Gold sponsors include EY, Fasken, SFU Beauty School, National Bank, and UBC Sauder School of Business. Silver sponsors are Vantech Angel Network, TELUS Ventures, and Volition. My bronze sponsors are, of course, RBCx, who's speaking with us today, as well as AceTech, Angel Forum, Backstretch Recruitment, VEF, and webnames.ca. So RBCx joined New Ventures BC as a sponsor last year, and they've been super supportive, engaged part of the ecosystem here in Vancouver. And one of the things they do is this talk and seminar for early stage companies around financing. So really pleased to offer this one again. Questions are kind of expected and encouraged, so you can ask questions in the chat throughout, and myself or Liz here will make sure we try to get as many answered as we can. You also have the option of putting up your virtual Zoom hand, and we can call on you, and you're welcome to unmute yourself and ask a question directly. So whatever you prefer. Okay, so today we have speaking to us Laith Shukri from RBCx, and I'm just going to pass it over to Laith. And we already had a question for you, Laith, which is, what is the difference between RBC and RBCx? So why don't you start with that in your intro? But thanks again.
Angie, thank you so much. And also thank you to our partners, New Ventures BC, for having me today to talk about, I guess, like perfecting your pitch deck, or, you know, how to pitch to investors, or essentially like how to fundraise. So yes, so my name is Laith. I'm the director for ecosystem engagement at RBCx. And it's a funny question that just kind of popped up there, because that was literally going to be part of my intro, where I was just going to talk about what RBCx even is. Think of us as the tech platform that is part of RBC that looks solely after the startup tech and innovation ecosystem. So you've got the greater RBC, which handles the other sort of financial sectors and looks at different industries, etc. RBCx focuses almost solely, actually solely, at tech and innovation. So we are essentially building the next gen platform that helps cover the needs, wants of founders going from different milestones as they're growing, from ideation, pre-rev, rev, seed, A, B, C, all the way to IPO and beyond that. We're trying to build a holistic, I guess, a platform. We've got 4 pillars in there: banking, capital, ventures, and platform. Banking essentially is pretty self-explanatory. It's everything on the banking side to basically serve founders' needs when it comes to anything sort of on the financial side. Capital is our investment arm, where we do investments in several funds. So we're actually invested in several of the biggest venture capital funds in Canada as a limited partner. And we also do some select direct investments, but those are very few and far between. It's what I like to describe as reverse deal flow, where basically we go out and find the deals to actually go and invest in. And then ventures is our acquisitions arm. So you actually may have seen there was an acquisition story for Ojo Canada that we've actually sort of acquired. This happened, I think, like maybe a month or two ago. I don't know. Time flies. It's June tomorrow. It's already at half year. So the entire idea behind ventures is we look at acquiring, scaling, and growing these different businesses within the RBC ecosystem in order to drive more business within the RBC ecosystem and drive more customers towards RBC. Some examples are like Owner, Mido, Dr. Bill, Ojo being one of them, etc. You can read more about all this on rbcx.com, and you can actually dive deep into the sort of like the different tabs. Platform is essentially the, I guess, the agency. I think of it as the agency model, or sort of like the mesh. And the best sort of reference, and this may date me, but if you remember a show called Entourage, you basically had a agency that was looking after all the different sort of celebrities, and you had one guy called Ari. Platform is basically Ari. So basically, we're there to take care of all the different needs. So if a company or a client of ours needs, I'd say, introductions to a general partner at a certain fund, we take care of that. If they're looking to hire somebody specifically, like a VP of engineering or a VP of sales or a head of product, we help make those connections and help them find the different sort of missing gaps. So if you look at it, if you step back again and you look at the 4 pillars, it really does sort of encompass all sorts of different things within the tech ecosystem. And we're very, very much determined to serve the founder every step of the way and help them get across all the different sort of milestones. And it really is about building that next gen platform. I say this a lot, and I actually kind of throw this in at the end of some of my PowerPoints, where it's like where we speak startup or we actually get entrepreneurs. And I think that's the best way that I can describe what RBCx is. And I hope that answers your question. So RBC, So for perfecting your pitch deck, we're going to go through, I guess, like a couple slides. Again, this is 10 slides. They're a little dense in terms of just like the text and information on them. Please don't take your time essentially reading them right now. Like, you'll get a copy of this later. But feel free to please just ask as many questions as possible. Like, I'm really more comfortable with people throwing questions at me, whether it's like chat or whether it's like I want to put up my hand and I want to talk to Laith and I want to ask him questions sort of like, vocally. And I will basically be walking you through these slides and giving you like the extreme, like sort of like, here's the takeaways that you actually need to know from all this information. Like, yes, I know it's a lot of information on the slide right now. Here's here's your best like 3 points or your takeaway that you need to know. So let's get started. So before we even like understand like perfecting the pitch, we need to understand who this pitch is going to, right? It's to an investor. And investors are just like us. They're human. They put their pants, they put their clothes on every single morning. They go to office, they they do work, they look at deals, they try to do their best judgment calls on all these different sort of companies that are coming their way, and then they have to make these calls whether to invest or not. Investors are a lot more similar to startups than startups would actually seem to think in the very initial period. And fund economics is literally one of those like sort of stark similarities. So just as a founder needs to raise capital from investors or from a VC firm, a VC firm actually needs to go raise that money from what is known as LPs or limited partners. So the entire point is, as a VC, let's say I'm Laith VC, or let's say we have Angie who's a VC. Angie actually goes out and raises money from corporates, from their investment arms, from high net worth individuals, from pension funds, from other VCs that are fund of funds like the BDC, et cetera, or like Kensington Capital, that sort of stuff. And what they do is, all right, well, now I've got my fund of, let's say, 100 million or so. And the expectation now is I have probably 5 to 7 years or 7 to 10, depending on what I'm able to set up in my LPA agreement or limited partner agreement, which denotes, what my fund size is, who my limited partners are, what my thesis is, what my average check size is. Do I lead investments? Do I follow on investments? Do I co-lead? This document basically determines my entire behavior as a fund. Also within that document and within my agreement with my limited partners, I also have to return this money to them. And I now have 100 million, obviously hypothetically. I've now got, maybe for the duration of that fund life cycle, there's two things. First off, 2/3 of that money is now basically given towards, I guess like 2/3 of that money is set aside for follow-on investments. 1/3 of that is basically set for fresh investments. So this is like net new investments where I'm writing fresh checks into companies. And then the 2 out of 3 is basically set aside so that I can actually double down or triple down on some of these companies and investments. And then within that 2 out of 3, there's also the 2% and the 20%, or sorry, the 2% sort of management fees, which I take every single year because I need to pay my own individuals, right? I need to pay my associates, I need to pay my principals, I need to pay my partners, I need to pay everybody. And I also need to keep the lights on. I need to like buy office equipment, computer desks, etc. It's literally overhead expenses. Now, there is an expectation at the end of the fund life cycle that I return the money, just as I've said before. With inflation, I cannot return $1 for every dollar invested, because technically that means I lost, right? And that means I'm not a very good VC. The aim, hopefully, is to return more than $1 per dollar invested. The actual ideal is obviously $10 or $100 for every dollar invested, i.e., the search for the the search for that unicorn. And most funds end up usually returning between like 1 to 2 or 2 to 3. And the idea is that basically that's the pressure that I have. So with every single investment decision that I'm making, so when I'm looking at like, let's say, Valen's company, or if I'm looking at like my colleague who's on this call, Maria's company, I'm trying to decide whether this company will actually return multiples of dollars worth for every dollar I invested in them, right? If I wrote Angie a check for 1 million, is her company going to return 5 million, 10 million later? Because I need to pay back that fund and make more money on top of it as well to keep my investors happy, so that I can go back to them later and raise a fund 2, a fund 3, a fund 4, so on and so forth. The 20% you see, which is carried interest, this is the 20% of net returns. So if I did a good job and we had some fantastic exits and we, and we did a bang, and we did a banger of a job, we actually invested in like amazing companies and we all, we're celebrating and, with champagne in the office, we would get that 20% of the net returns. Obviously, the first people to get paid out of anything is obviously it goes back to the LPs, and then we get the rest. We get whatever's left from, which is the 20%. But the 20% is usually known because we're the ones that are managing the money, and we're the ones that are actually going out and looking for the deals. We're the ones that are doing the due diligence. We're the ones that are setting the terms. We're basically the ones that are actually doing things with the money, versus the LP who just gave us the money and then every once in a while we go and update them. There's a lot more stuff that I can talk about here, but essentially just fund economics, what you should know is investors also need to raise money. And then because they raise money from LPs, they need to return that money, but they also need to return multiples of that money. Therefore, when they look at investments, it's usually a function of what is this investment going to return to my fund 5 to 7 years from now? Is this a fast enough growing company that'll actually return that for me? Yes or no? And it really does come down to that at the end of the day. Again, like if you have any questions, like just put your hand up or put it in chat, etc. So here's a good mathematical example. And this is where I kind of mentioned that like if you kind of go 1 for 1, or if you go more than 2x to 3, or if you go 2 to 3x, you'll kind of see that there's some return. 10x obviously is like the ultimate ideal and goal for most funds. But you can kind of see it here where we have a 1.5x returning fund versus a 3x returning fund. And you can kind of see that they raised the same amount of money, right? 20 million in write-offs basically means just like, first off, they take 20 million in fees because it's just like, this is what we need to, do all that sort of stuff. And then 20 million in write-offs, basically, there's always, I mean, the venture math usually denotes that for every 10 investments, you'll probably have a couple write-offs and a couple duds within like the portfolio. And these are companies that you will never see money from again. Like these aren't companies that just sort of like flatline and just sort of like stay stagnant. No, these are companies that like end up shutting down. Those are usually like 1 or 2 like within like every 10. Then the majority of the 10 are companies that are just like doing okay. They're doing fine. They're not doing great. They're not doing awful. And then you've got like maybe 1 or 2 that are doing like amazing, which usually pay back for the other bunch. So you can kind of see it here where it's like 20 million in write-offs. After write-offs, like here's how much we have money, portfolio value. You're looking at like how much you repay back to your LPs, etc. And you can kind of see like if you return 3x the fund for a 100 million fund, the GPs make 24 million, which is not like peanuts at all. But that's a lot of work for them to get to that 24. It takes a lot of hard work and effort, and the amount of deal flow that they would actually have to go through so that they can actually land at such a win is actually significant. To give you an example, previously I used to work at Scale Up Ventures. Scale Up Ventures is a downtown is a Toronto-based VC. We used to do seed and Series A investments. Primarily, we used to look at marketplaces, SMB SaaS, a little bit of life science, and data and cybersecurity, as well as like some fintech. So data, cybersecurity / fintech. It was within that little cluster. A lot of the times we would be looking at, sort of like, well, when we're writing a check, what was the I guess like the odds that every single one of our portfolio companies would return that sum to the rest of the fund. And we were about 100 million as well. So we were actually, I think, about 106 or 109, if I remember correctly. But these were things that we actually used to look at. Another thing which isn't quite mentioned in these slides is the reserves. So usually if like, I've got my 100 million, I've got stuff set on the side to basically triple down on the investments. Usually as time goes by and my fresh powder or like my fresh capability to actually invest in like net new logos sort of starts to go away, which is natural. It's not something that's bad. It happens over time that I've got less and less cash to do fresh investments in. you're able to do follow-on investments, and usually follow-on is key to your own portfolio. What you end up is with a ranking or like a ladder system with your different portfolio companies, and you're constantly ranking and re-ranking them depending on like where they're at and how they're performing, and like how much money you have left that you want to actually give them. And it's not something where they all get equal amounts of cash, because no company is created equal, and their growth is not equal as well. So every once in a while, you would actually revisit the reserve pool, and actually redo the reserves and shift allocations. So you'd be like, I'm going to take $1 million from like Laith's company and put it towards like Valen, or I'm going to take like 250 from Maria's and put it towards like Angie's, etc. So this is kind of like how fund economics works. And at the end of the day, it's because when the fund ends, I need to go back to my LPs. I need to give them like a big presentation and tell them, here's the return on investment, and here's how much we did, and here's the success, here's the / maybe failure. This is where my career ends, or maybe I go and I raise like another fund, and we see how things go. Again, any questions, please go ahead and ask.
We do have some questions, but I don't think they're related particularly to that slide. So do you want to save those later, or just throw them out to you now?
Sure, I can take them right now.
Yeah.
That's fine.
Okay, cool. One of them is, does RBCx co-invest if another bank or credit union has already invested?
Okay, so the question is, do we co-invest? So we don't invest. I mean, if it's a question as a lending, like if you have a loan, let's say from like, or if you have like a line from like TD, would we come in? The answer is yes. It actually depends. What ends up happening with lenders, especially in the tech and innovation space, is, let's say in like your Series A round, you got venture debt from I don't know, from like one of our competitors. That's fine. It's not like we're going to tell you to go away and shut the door. When it comes to your next round, however, and you're coming to talk to us, and let's say we're objectively the better deal and you're coming with us, what tends to happen with that is when a lender sees that there's another lender in a previous round, you start talking about debt seniority. So you actually start the talks of actually making sure that, well, if you're raising capital or if you're starting to pay back on that loan or facility, I get paid first, and then so-and-so gets their money. So that's sort of like the main talk that tends to happen. On larger deals, so like on like super large deals where there's many a zero, you will sometimes find multiple banks sort of cutting up the facility, because it's just like way too big for one bank to take on, and that's also normal. So yes, so like banks will cooperate on deals. We're friends sometimes.
That's right, when it makes sense. And just another one around a range for a typical interest rate for raising funds, or I guess getting lending. What's considered a high interest rate that a startup should or should not consider?
What's a high interest rate? That's actually a very good question. Okay, so there's a couple things. I mean, most of the time, like you'd find lenders try and stick to. I will say this also, having worked at Silicon Valley Bank at the time, like it's quite similar to here. Usually it's around single digit, lower half. So what I mean by lower half is like about like, or like less than double digits, somewhere like between like 6 and 9%, like it was somewhere there. Sometimes it'd be like between, or like closer to 5 or something like that. It's constantly shifting depending on like what the market is. So like you'd always want to ask. The thing to do as a founder when you're looking for different debt deals or debt facilities is to always just try to get quotes from everybody and then actually sit down and compare. And if there's a bank that you really want to go to, you can go back to them and say like, hey, look, I have like a better deal from another bank. Like, can you match this, or can you do something better? And that's something that founders used to do. That's something we used to do at Scale Up when we used to work with RBC and SVB and like, all the others. We would actually go back and just say, hey, our founder found a better deal with this bank. Can you actually match it? Can you do something better, et cetera, et cetera. Interest rate that founders should not go for, probably anything like double digits, or like something that's like absolutely crazy in terms of just like, this is like a crazy, like really ultra high, like again, like you need to know your own economics and like your ability to kind of take on that type of interest or that type of debt. At the end of the day, like you're the person that signs it. Like no bank is basically locking you in a room and saying like you can't get out of here unless you sign this. Um, so objectively, like you need to understand like what your risk appetite actually is and what your capability is. Should anything change or shift, or should the ground shift from underneath you suddenly? Can you weather those changes? But for the most part, it's anything that's like double digits is probably a little bit too high. Like anything above like 9% usually is just like that's a little crazy.
Okay, cool. All right, onward. We're good.
Cool. So why was Laith talking about, you know, the different sort of funds, and he was talking about like returning it to investors and, you know, all that sort of stuff? It's because when you're creating your pitch deck, like when you're even putting this like presentation together, when you're putting in, you know, here's problem slide, here's solution, team slide, here's how much I'm raising, you know, etc. You need to know your audience. You need to know exactly who you're talking to. You need to understand and empathize with how their decision making sort of like, or how their decision tree kind of works. And more importantly, you need to understand their criteria. I think the criteria thing is something that um, is it's something that founders just need to really understand. And we used to see it a lot back in the scale up days where we had a lot of founders that would reach out to us and just not know the criteria. And it became very obvious that founders had just typed in, I don't know, Toronto based VCs and just started emailing people. Understanding the criteria, um, and I would actually add another point, which is right before speak to their interests. So understand their criteria and understand the fund position and life cycle and like vintage is a couple of the more important things. So criteria is, what do I look at? You know, what are the different industries that I look at? Do I look outside of my province? Am I Canada wide, or do I just do investments in BC? Do I do investments from like zero revenue up to maybe $1 million in revenue a year? Or am I just a person who looks at, or am I just a fund that looks at like 10 million ARR and up? Am I looking for 30% month over month growth, or am I looking for 50%? So that's the criteria that you need to understand. What do investors actually look for? If they lead, if they co-lead, if they don't lead at all, if they just sort of commit and say, go find a lead investor and then I'll, you know, throw in my cash. You'll also try to get a sense of like how they invest and what kind of deal, what kind of terms they like to take in different deals, as well as their behavior and mindset when things go sideways. And this is something that's super important to know. I'm going to throw another caveat in here and say, please always do due diligence on your investors, just as your investors are doing due diligence on your company. If you sign with an investor and they turn out to be absolutely horrific, it's on you. You signed it. No one made you sign it. So you need to understand that that's a huge responsibility and something you need to do. Back to this though. You need to understand empathize decision making, what their criteria is, and then I mentioned fund vintage. So if Angie has a fund that was set up in 2019, she's now 4 years into that fund, right? Out of a 5 to 7 year maybe life cycle, she's probably still looking at investments, right? She's probably still writing checks. If you look at Maria's fund, which was established in maybe 2017, that's now 6 years old as a fund, probably now looking at follow-on investments, not really looking at new deals, right? So another thing to kind of make sure is, you know, in terms of knowing your audience, is this person probably going to write you a check, yes or no? It's really easy to look this stuff up. You can pretty much like just go to Crunchbase, you can do the free trial and it'll give you like the Crunchbase Pro or whatever. I don't know if that still works, but it is very, very, very much worth it. And then you can start looking into when was the last investment that they made. You can also check out their portfolio. You can actually see if there's anything sort of competing in there, all that sort of stuff. And you can kind of like mine that information and figure out who these people are. Speak to their interests, literally their thesis. So if you're looking at, you know, if you're a marketplace, if you're an SMB marketplace or an SMB SaaS company that's looking at, I don't know, solving home renovations or the influencer market or, you know, whatever it is, and I look solely at deep tech and artificial intelligence, we're not going to have a good productive meeting. It's just not going to happen, right? It doesn't matter how fast you're growing. it doesn't matter anything really, because that's just not my thesis. That's not what I invest in. That's not my area of expertise. So these are the different things where we need to actually sort of be very much aligned. Is the thesis aligned? Do we get along as as individuals, as human beings? Is Laith still investing? Will he actually, does it check the boxes for like everything? Can I get like a warm intro? We'll talk about that later, and all that sort of stuff.
Okay, just a few follow-up questions from here. What
Sure.
activities, this is from Jessica, what activities would you recommend for doing due diligence on an investor?
Okay, so what activities would I do, or what activities do I recommend to do, like sort of due diligence? So if I were to do due diligence on an investor, what would I do? Simply put, I would try to speak first with your peers. Has anyone spoken with Angie or Valen about? I'm gonna use Steve Jobs on this on this slide. Has anyone talked to them about Steve? Do they know what Steve's like? As an investor, he came in and he led you around, Maria. Is Steve, has Steve been helpful? Has he actually, come through with the introductions that he's actually promised? How does he behave, when things are going sideways? Does he just, sort of ignore your calls? Does he ignore your emails, etc.? Or is he actually stepping in and saying like, hey, I can help you. Here's what we can do. Let's actually sit down and like meet regularly, all that sort of stuff. I'm going to use my scale up experience again and say we had one company that was going through a very tough pivot. This was actually when I first joined. This was back in 2019. That company was going through a very tough pivot. It was not easy on the founder. It was not easy on the founding team. And you can kind of see it. It was sort of like this air that was like hanging in the boardroom whenever we'd go in for the quarterly meetings, where they were tired. You can kind of see that, they had their chin up, but you can kind of see that, they still had their doubts that, maybe this wasn't going to work, but they were really trying to sort of like push through and make it work. As one of their very few institutional investors, and as their lead investor in their previous round for their A, we actually were very much involved, almost on a weekly basis with the founder. So we'd actually meet with them very frequently, talk to them about all their issues, try to help them as much as we can. So that was basically one of the things. So when people now talk to this founder about how does Scale Up behave when things are getting rough, they can now tell them that like, oh no, Scale Up will be there every single step of the way. They helped us through this stuff. And then here's the sort of the few examples. You can also get a sense of the investor behavior and temperament by the type of deal and terms that they actually present, and how argumentative or how like forward or how aggressive they are with their terms. So that's another thing that you can actually ask your friends and say, oh, did you ever get a term sheet from this? Like, yes, but the terms were actually awful and they wouldn't back down from like any of the clauses. And like, we ended up moving away. We ended up looking at like all these, other investors, and then we closed around with these other people over there. So due diligence is something that's like very, very key. Try to get the sentiment, try to understand who these individuals are. Because again, you sign that shareholder agreement, you're stuck with them for the next little while. And by little while, I mean like 5-7 years at least. And it's not easy to sort of separate. It's literally like getting married. Like not one for one, but close enough.
It's a relationship for sure. Masa was asking in terms of how do you find out about terms? Is that only through the term sheet, or is that something you discover through the interview process?
The terms, yes. That is actually a really good question. So it's like, do you find out about the terms only through the term sheet? And it's like where you talk to them, and then all of a sudden magically they present you with like, here comes the bill from the from the night out. No. So usually what happens is as you talk to the VCs more, so you go through a couple meetings where you're pitching to them, or you get a couple meetings where you're just introing and you're learning more about one another. After your first, like maybe your second, like after your first pitch or after like your introductory meeting, you will learn more so on their positions, on like what they want to see and how they behave at a high level. So you'll understand that if they like to lead, if they co-lead, if they don't lead at all, if they do follow on, where they're at in the fund, their criteria, all that sort of stuff. Like they'll start to tell you more and more about that. The more intricate level or the more intricate details about their terms, that starts to show after the initial few meetings and after you start going through due diligence with the VCs.
Okay. Let's do, let's see what else. Oh, any other options besides Crunchbase for researching investors other than Google, I guess? Anything else?
I was fascinated to know that ChatGPT and like the AIs are now sort of stepping in and they're actually doing quite a good job.
Okay.
2016 Laith would be sweating. I'd be sweating a little bit because that was literally my job. My job was, I'd have like Angie show up and be like, I want to raise a round. And I would sit down with Angie and we would figure out like a good list of investors and I would work with her one-on-one and getting her all those introductions. But if you can do that all now with an AI by asking it a couple questions, very, very interesting. It's a very, very interesting time that we now live in. And the fact that it might not be completely accurate information, but it is enough to make me look at it twice and go, huh, that's quite impressive. And it just learns. So it'll just get better from there in terms of quality of information. Crunchbase is a good one. I still maintain Crunchbase is like like a good solid choice. You have the more expensive options. Again, like they're way too expensive. You get the CB Insights and the pitch books. However, word of caution about all of this stuff is none of it is accurate, or as accurate as you'd like it to, as accurate as you'd like it to be. The best way I can describe it is that if you're trying to get like a picture level on a wall, think of like the Crunchbases and the pitch books and whatever as you doing sort of like, you're trying to do this and you're trying to get a sense of like, is it level, or you're trying to do that and try to see like, is it straight up, or, whatever. You're not using any lasers or any professional like level devices to get it there. Like that's not what any of these things are. CVCA intelligence to those who actually have access to it is also pretty good. But again, the data is a little stale and old sometimes because the way VCs report usually skips like a quarter or like a couple months and then they'll report a fundraising round. And then most of these softwares were built with the US market in mind. So when you look at the Canadian ecosystem, the accuracy like drops, and it actually drops hilariously. But again, that's not to say don't use Crunchbase or any of these softwares. It's a good way to kind of just get a ballpark understanding of like where you're at and who's on the playing field with you.
Okay.
I would use it as data enrichment, if that makes any sense.
Yeah, that sounds good. Okay, we do have more questions, but I know you don't have a ton of slides, but I do want you to get through them. So why don't we continue on a bit?
Yeah,
then we'll go more. Yeah,
that's fine.
Okay.
I guess so I guess on this slide, we've got the man, the best storyteller or one of the best storytellers on the planet, right there, hunched over his Macintosh device. But basically it's like, well, why is all this important? It was like, well, you need to understand your audience, because if you understand your audience, then you're able to craft a good enough story for them. So you can captivate them, so you can capture their attention, so you can win them over. And most powerful person is a storyteller, right? Storyteller sets the vision, the values, and the Zoom windows are in the way, and the agenda. So at any stage from seed to IPO, pitch decks must convince investors. So the entire point from this is that you're the right team, right? You're the amazing people that are going to win, right? You're the ones that are going to beat out the competition. You're going to like stomp them out, and you're going to own the market. You're going to build a substantial and sustainable company, right? You've got unique insight that'll help you do that, and a product that can scale. And you're going after a sufficiently large and scalable and growing market. And these three sort of come together. And I kind of want to add to this slide a little bit, and just say that venture capital money is short-term money. I'm going to say short-term with air quotes, because in the world of economics, short-term could be like 5-7 years, and when you're looking long-term, it's a lot longer than that, obviously. But the entire idea is that VC money usually comes in the adolescent phase of the company, when it's too young for proper institutional financing, and it just got some grant money or maybe some friends and family money from angels, right? There's a little awkward gap. Those are the awkward teen years. That's where VC money comes in. If you look at that period in time and you want to actually assess, I guess, like ROI, so think of it as a triangle. ROI is the vertical aspect of that triangle. Your growth curve has to be like almost vertical, right? Because you're looking at, this is the time in which VCs would invest and exit. They want to make this much money off of you. And at this point in time, you're trying to basically differentiate yourself from a bunch of other companies that are almost homogeneous to your product. So usually whenever a new niche is found, or when you're early enough in a growing market, there's probably like a dozen of you that are all doing the same thing, slightly different flavors, right? But the core differentiator is the narrative, the vision, and the team. And when investors usually say, I invest in team, it's usually that one. That's usually when team really matters, right? The horses are all the same almost. It's almost like NASCAR even, where you all have the same engines, you've got the same weight class, you've got the same everything. But what really sets you apart is the driver and the team in the pit stop that can actually get you out there faster and faster. So just know that. That's basically the takeaway from this slide. Let me just minimize this just so I can actually not have to move it around as much. Narrative elements, things to kind of focus on when you're actually pitching to investors. Technology companies, I mean, the startups, primary currency is growth rather than profit. Profitability is always an added bonus, but most of the time what they're trying to see, what they as an investors are trying to see is that you're growing fast enough and that you're going to capture more and more of the market. That's really all they care about, because the more market share you grab, the more sort of, I guess, like valuable your company is. And for them, well, they own equity in this company. That means their share in the company also grows in value. That's basically how it works. A lot of companies don't have, CapEx or hardware or little variable costs, which means they can achieve scale much more rapidly than traditional businesses, right? That's just I think that's what sets software companies apart. Growth is usually exponential with these fast-growing companies. So you will actually see like really successful companies grow, like, I'm not going to say overnight, but you do start to see the difference quarter over quarter. In terms of like the number of customers, the amount of revenue, the amount of, I guess, like the amount of like users, the daily active users, monthly active users, the drop in churn, the increase in retention, the LTV CAC ratio kind of starting to shoot up. Like you actually start seeing all these different sort of levers and dials actually all sort of trend in the right way. Life cycles are accelerated, yes. And if you ever work at an accelerator, this will be a very true thing to see, not from a founder perspective, but from the accelerator people. You'll actually see companies like grow or be born, grow, die, explode, go into like multiple fundraising rounds, and it'll all happen within like a year. And like time feels very dilated. But the best companies always progress within a few years straight to IPO or get bought because of just how much determination they actually have in growing these companies. Network effects and winner take all basically create the power law distribution. Power law is the infamous sort of concept that was introduced by Peter Thiel. It's a very good book, honestly. It's called 0 to 1. And it basically just means that you just start doubling, tripling, quadrupling, quintupling, and whatever uppling down on your most successful companies. And it's usually always a small percentage of those companies that are your biggest winners. And those are the ones that you should focus on. And everybody else, you should not focus on whatever. So you should just focus on, like, let's say you've got a pool of 10 companies and you got 2 of them that are really starting to like break through and skyrocket. The other 8 are a write-off. Or at least that's how Thiel thinks about it. And that's how power law thinks about it. So power law kicks in simply because you have these couple companies that are growing at such a speed. The investors, and we talked about the reserves earlier, the reserves slowly start going only to those companies and start getting drained away from the other portfolio companies. It happens, I've seen it. And it's just sort of like how how the distribution law works. Again, I highly recommend that book, by the way. I talked about the statistics of some companies. You can kind of see it over here. There's a lot of text on this slide, but basically power law distributions. So 10 companies will be written off or written down. 8 companies will return costs, so they'll do fine. But that 1 or 2 companies, those are going to be your rock stars in any portfolio. The goal of every single founder is to be one of those 2, or that one company. But life does not work that way. It's just a matter of fact where we can't all be winners. Companies can't all be winners. VCs can't all be winners. And that's where the distribution sort of starts to kick in. And that's where you can kind of see like a very stark reminder of the economics and sort of like the more capitalistic drive that VCs have with regards to return and profitability. And then investors aren't afraid of losing money. They're more afraid of losing out on the opportunity. I guess that's the real fear that they have, is seeing that one deal and going, and then that one deal turning into like $1 billion business. They hate that. And then you'll have some of them go on Twitter and be like, well, I remember I passed on that company, and they'll try to humble brag about it or whatever, and it's kind of funny. But investors are not afraid of losing money. It's dozens of shot on goal, but they are, however, deathly afraid of passing on the 1 or 2 outlier companies. That's the main takeaway, is how do you position yourself to be one of those 2 outlier companies that VCs will literally fight each other over you to win that deal. And that's basically where this all sort of boils down to, is how do you create that FOMO? But that's a whole different topic with regards to like how do you actually go out and fundraise, and the strategy behind that. And there's a couple tactics that I can share with this group as well. So the storytelling, I'm not going to get into this. This is just way too many words. But at the same time, instead of this, I will suggest you go look up 2 resources. They are both from Y Combinator. One of them is it's the pitch deck template from Y Combinator. So it'll literally give you the template for a pitch deck. And in my opinion, they're probably one of like the top sort of like sources on building these like early type resources. Take that template. The other resource is also Y Combinator. That one actually tells you more on like the formatting side of like, don't put too many images, focus more on the message, try to boil down everything down to like 3-4 bullet points per slide, that type of stuff. But you can literally just type in like Y Combinator seed deck template or seed pitch deck template or something like that, and you'll see both of them. They'll pop up. One of them is more, you'll know which one's which. One of them I remember has like a green background that talks about like coloring and all that sort of stuff, but you want the other one first. This is more so on, I guess, like the stage and industry of the company. It's basically just like the expectation of investors. Pre-revenue companies, it really is a matter of, it's the team, right? Founders, are you relevant? Like do you have the relevant experience? Sorry. Do they have previous entrepreneurial success? That one actually leads to a lot of bias, where it's like if you have a multiple time founder, it's just easier and easier for them to raise more money, like even like at ideation phase, because like their earlier backers remember that they had a successful exit, so they'll write them a check almost immediately. The third one is actually an interesting shift in age. So in the I guess like in the earlier part of the 2000s and like the 2010s, the average age of the entrepreneur was like, it was like the kid coming out of college who was in the hoodie. But nowadays you're sort of starting to see this age shift of like these entrepreneurs that are now older and older. Basically, they come from industry. They've worked in these industries. They understand the pain points of those industries and they want to solve them, and they know exactly how to do it. Also, they have all the connections in the industry because they've been working there for so long. So they're basically industry vets. Other non-revenue proof points, you're looking for any sort of like pilots. Are you generating any revenue from that? Is there one-time revenue? Low churn, I'm basically looking for product market fit here. Low churn for those who don't know, is basically people churning basically moving away or unsubscribing or not paying anymore for your product. So you're losing them as a customer. One key indicator of early product market fit is your churn starts to decrease. So you actually start to see more and more people accept your product and pay for it and stay on as subscribers or more paying customers, etc. On the revenue generating companies, I wouldn't say it's 60 to 80%, which is the at least the, well, actually, no, it is for year over year growth. That checks out. When I was speaking with a company once about venture capital and like the expectation of growth of venture capital, my former boss at Scale Up actually put it in a very, very good way, where he told that founder, hey, imagine you're standing at the top of a very, very steep hill and someone comes up behind you and shoves you. What do you do? So the best thing to do right now is to just run, right? You need to run down the hill. Otherwise, center of gravity goes up and then you fall flat on your face. That's basically venture capital money. They're basically asking you to run as fast as you can down that hill. And then every once in a while, another VC catches up to you and gives you another shove. And you just keep running and you keep running and running and running at faster and faster speeds. The idea here is there's a high pressure on growth. And I think some founders don't quite understand the expectation on the need and want from the VC side that you need to be growing constantly. And you need to meet your valuation and exceed it for the next round. So not all companies you're building will end up being venture backable, but this is something that you need to know, especially when it comes to the financial metrics and the growth metrics specifically. But yeah, that basically, I mean, that was that. Are there any questions related to this, Angie, or anything there? Or
There are questions, but I don't know if specific to this slide per se. So, do you want to finish that last slide and then we'll just start a little
so this is the last slide. You can kind of like, you can kind of see this. There's a ton of different graphs on this where it's like focus shifts as the ventures grow. So like you'll kind of see like at the founding and pre-seed, the emphasis is on team. Pre-seed, seed, it's still emphasis on team, but now you've got some paying customers here and there. You're starting to grow your revenue out a little bit. Series A, between seed and Series A, like you now have a product. You've achieved basically maybe 70 to 80% product market fit, and now you're starting to focus on sales and marketing, and you're starting to grow your business out a little bit more, and you're still trying to hone in on that final niche of product market fit. B and beyond, there's a lot more financial analytics that actually happens. So you can kind of see it there: LTV, CAC, churn, gross margins, etc. But then B and then crossover and onwards is usually where the company starts to grow geographically. And then you start adding products, you start acquiring other companies, you're thinking about going public, and you're thinking about going larger and larger at that point. But that's sort of like the shift there. I'm happy to explain this a little bit more detail, like if anyone has any questions, but I know it's just like a lot of words like right here. But,
okay, cool. Yeah, if anyone wants more clarification, maybe just note that in the chat. Otherwise, I got some questions for you. I've got a lot of chat here. That said, if anyone wants to ask live, you're still welcome to put up your hand and do so. But okay, let's see what we can get through in the next 10 minutes or so. So from Amy, how do VCs modify this approach for industries with a slower time to revenue? So example, agriculture, human health, that require regulatory vetting or biological testing. And it's a two-parter question. And how does this approach change with lower revenue, social impact focused businesses? So I guess, yeah, how do you modify by sector?
So that is a good question. So you do have sector-specific investors. And because you have sector-specific investors, those investors are actually geared and ready to actually, well, they're geared and able to look at the deals in those specific lenses. So with regards to health, life science, VCs or health and life science startups, they behave very differently than their software brothers and sisters. Because they scale differently, they operate differently. Most of the time you're raising money because you're trying to get through trials. or maybe try to get to like the experimental, like, or within the first phase of an experimental drug, or the first version of it, you know, that type of stuff. The way VCs in health and life science look at things is very, very different software. So it's understood that, you know, you're raising capital because you need to get to this phase or you need to get to the next phase. And the idea is that most of these companies usually raise like a couple rounds and then they get acquired by like a big pharmaceutical for like a ton of money. So there's a lot more patience and understanding there. Also, most of the health and life science based VCs tend to have people that come from pharma or come from the medical industry. So they actually understand how this industry works and how it ticks. So when you're actually trying to build something that has IP within that industry, they actually understand the timelines and all the different sort of hurdles you actually want. That's actually something that I would suggest to this group. If you are in a specialized field, like let's say in agriculture, in clean tech, health, life science, pharma, deep technologies, AI, etc., do seek out specialized VCs, because specialized VCs will be the most empathetic and understanding towards where you're at and how they can help you to get to the next milestone, because they're the ones that have actually either done it or have financed companies previously in the past within that industry and therefore know how it ticks and how it works and how it behaves. Yes.
Okay.
Hope that answers the question.
Yeah, I've got a question from a different Angie. Angie's asking, how has the current economic environment and layoffs impacted VC's push for the growth at all costs mentality?
That's a good, so how has it affected the growth at all costs mentality? So number one, with regards to the current macro environment, I think there is a bit of a pullback. So there's a little bit of a pullback from some VCs, which are now looking at this economy where they're like, all right, I'm not going to invest. You have some VCs that are saying, I'm not going to invest as much, right? I'm just going to wait this out. You've got some VCs that are just now saying, I need to get signal from, like, before I invest in Angie's company, I need to look at Maria and see if Maria will invest in this company after I invest in it. So if this company is at seed and I invest in it and then bring it to A, Maria as a Series B investor, will she then take this on? So you're having a little bit of a loss of signal right now currently in market, where I'm looking at the investor that comes after me, trying to get a reading, and I'm not getting a clear signal. Therefore, I leave Angie high and dry when it looks at sort of like investing, because that means I'm deploying capital, but I'm left with no sort of like I'm left with no sort of like growth trajectory for my company and my portfolio. Exactly. That's one. Two, raising money right now is a little bit more expensive. I mean, it just is. I think it's kind of caught up. Valuations are not what they used to be at all. So this is not 2019, 2020 anymore. And this is something that founders need to actually understand and accept, which brings another set of problems where you have founder expectation, where I want to raise this valuation, but VCs are saying you're actually at this valuation over here. And obviously that's always been a dance between the two, but in current market scheme, like in current market conditions, like your valuations are just lower. The other issue is you've got founders who have raised at high valuations like a year or two ago, who are now looking to raise their next round, and their valuation is being smushed a little bit. It's either being kept the same or it's being like the growth is being flattened versus sort of having that steady increase in valuation. So you're kind of having that that issue happen.
Okay, good answers. Okay, Chris is asking, what would the main metrics be to measure, I guess, traction progress for a pre-revenue company?
Traction, what is the key metric for traction progress for a pre-revenue company?
Yeah,
So
or as an investor, what metrics are you looking for at pre-revenue companies?
So we had that previously on a slide. Yep. Mostly it's going to be team. It's going to be team and like, you know, just are you like, how far along is your product? They're going to be looking for any letters of intent. They're going to be looking for any pilots that you might have. And then specifically within pilots, are any of these converting into paid pilots? And then they're waiting to see how fast you can actually start converting from pilot to paid. And basically what does the growth there look like in terms of like the first few months of revenue.
Okay, another quick one here. They've asked it twice, so I gotta make sure I answer it and ask it. So this person says their year-over-year growth is 130%. Sounds good. Is this the most important metric, or are there any other important metrics? And I think they're asking at that rate, should they be talking to VCs or banks?
Yes, so I think you should. I think so. I think you should always be talking to VCs and banks. So that's number one. Founders, please never treat it as a static point in time where it's a binary question where you're like, I need money, or like, do I need money? Yes, I go talk to VC or I go talk to bank. That's not how it works at all. Most VCs won't invest in like people they've just met. Most of the time it's relationship. Like this entire industry is based on relationships and networking. So do build, form, and maintain these relationships with investors. Go meet with them, go talk to them, even if you are early. Just meet with them. Don't have that expectation that like, hey, you're gonna invest in my company like today, and maintain those relationships. And then over time, as they start to see moving dots in a certain direction and trajectory, they will come. Like when the time comes to actually go raise capital, it's easier for you to have those discussions. Always talk to investors. For the 130% person, I would say, yeah, like go talk to investors. Try to figure out, what it is that you're trying to find, or, what it is that you want to raise from them. Is this the only metric? No. So saying that you're growing at 130% year over year is great, but it depends on what, and it depends, what kind of market this is. Is this market fast growing? Are you the only person in there? What does the growth of your other competitors look like? There's a whole slew of different questions that you'll be asked around that. So 130% is a great metric. It's not the only metric you should be talking about.
Yeah, sure, it gets people interested.
Yeah.
Okay, we've got a minute to go here, so sorry we couldn't get to all the questions, but maybe the best last question that's been asked is, how can people get in touch with either yourself, Laith, or RBCx, or how can people kind of continue this conversation?
So get in touch with RBCx. You've got Valen on the call, so you can bother him.
Okay.
For me, it's literally just Angie, you can share my email, but for everybody here, I don't know if there's a chat function I can actually like type in.
Yeah.
I can't seem to see it, but I will say that it is my first name, so LAITH dot SHUKRI, and then it's at rbc.com.
Okay, we can send that out too. And yeah, and Laith is in Toronto, but Valen is here in Vancouver and also with RBCx. So both are great resources.
Yep.
Okay, well, we are at time, so apologies everyone, I couldn't get all the questions answered, but thank you everyone for joining us. We actually sent a newsletter out this morning, and Vancouver loves last minute events, because I think half of you came from just sending out the newsletter this morning. So thanks everyone for joining us over your lunch hour. Thank you again, Laith, Valen, Maria, the whole RBCx team, for kind of interesting different insights from the kind of the investor lens. So appreciate it. Thanks again, and we're going to sign off. So everyone have a great day.
Please.
See you soon.
Excuse, please.
Okay. Thanks again.
Hello. Hello.
Yep. Everyone else, goodbye.
Please, I did not get the email for the guy. Can you repeat the email, please?
We'll email it out to you. No problem.
Thank you very much.
Okay, thanks. Okay, bye everyone. Thanks again, Laith. Nice to see you.
Cheers.
Thanks
Thank you.
again,
Thank you,
Valen
Hannah.
and Maria. Take care, everyone.